Welcome back to Investing and Trading Live, sponsored by Trading Academy, and I am your host, Josh Lilquist, with my good friend and my good pal, and he is Mr. Blue Man Group today. I mentioned that in the first segment, Mr. Al Connickson, and by the way, he looks good, and he does a good job at it. If you missed seats for that investing class that we do locally at the Academy, where we talk about how to start an investment plan, what are the right techniques, strategies for that, what are the components for an investment plan, simply just text the word investing to the number 210, and that's for 2 seats for this investing class right here in Bloomington or at a city near you. Simply just text the word investing to the number 210, one for you and one for a friend. Also, we appreciate our subscribers on the podcast. We are going to make this the number 1 global financial podcast one day, and we believe it's the top. Simply just go to Investing and Trading Live on Apple Podcasts, iHeartRadio, or Spotify. You can subscribe there. By the way, all podcasts are free. That's the nice thing about these podcasts is if we can enlighten you and inform you of what's going on in the financial markets to make smarter investing decisions, we have done our job. Simply go to Investing and Trading Live wherever you listen to podcasts. So, Al, in the last segment, you talked a little bit about an investment plan, some of the components, some of the steps, what you need to have. You need to have an entry point, an exit point. Matter of fact, 2 exit points, so that way you're protected on both ends. We talked a little bit about insurance, the correlation between physical fitness and the stock market, which nobody would ever think, but they are very, very similar. Now, the key is to be efficient with the dollars that you have. So, a lot of people want to understand more about how much money do I need to get started trading or investing? Do I need hundreds of dollars? Do I need thousands of dollars? Do I need tens of thousands of dollars or millions of dollars? Well, all the answers is sure, why not? It depends on what asset you're going to use, but also how efficient or how much efficiency that you want your dollars to have. So with the stock market, my opinion is you kind of need a lot of money to trade and invest because it ties up all your dollars. Very similar to paying cash for your house. That's what stocks are. You need the dollars to purchase it. Now, what if I told you there was assets to be more efficient? Very similar to the house example. If someone were to buy a house, most people probably use a mortgage, and which is leverage, which means they take a small down payment, they control a much larger asset. Basically, they control that whole house for a small amount of money, and then they make monthly payments on it. Right. The same concept is in the financial markets. Now, you're not using tens of thousands, hundreds of thousands of dollars, or making payments on something, but it's like a good faith deposit is what it is. So what that means is you can use a smaller amount of capital in the market to control much more, which means your rate of return is higher because you're using less dollars, but now you can do more with whatever dollar amount that you plan on using. Let's discuss those asset classes that allow that, but also some of the strategies that you help your students that are coming to the Academy that want to be efficient with their dollars.
Right. Well, that's a huge word as far as your ability to be successful as a trader, that efficiency. Let's call it like it is. It's getting more bang for your buck.
There you go.
Look at every dollar you have as an employee. If you owned a business and you had, say, 10 or 20 or 30 employees, and every day one person walked in, just went over to the corner of your office, laid down, and slept all day long, that person would not be very productive for you.
Everybody listening is probably like, they know that person.
And there's always someone like that who tries to get away with as little work as possible, not being very productive. So look at your dollars. Look at your investment dollars the same way. If each dollar that you invest could actually control something worth 10 times it or 20 times it or 100 times that dollar, that's efficiency. That lets you participate in the market with less money and also lets you participate with what we call position sizing, better position sizing. If you can invest $1 to control something worth, say, 20 times that amount, and you're wrong, number one, your risk is limited, and we're going to show you also how to make sure that you understand how to control risk. In fact, that's the number one thing we teach you. You need to know how to not lose first before you learn how to make money. But being efficient with your money, who does that? Who is the person, or who are the groups that do that? All the professional traders. Warren Buffett. Most people have heard Warren Buffett say things like, just invest in stocks, put your money in the stock, and hold on to it for years. invest in good companies. Basically what he's saying, invest in companies that I own and just hold on to those.
And create volatility for me is what he's saying.
Well, exactly. But Warren Buffett makes about $8 or $9 billion a year trading one of those leveraged assets. You mentioned leverage. That's where you can get the efficiency with your money, like a mortgage on a house. Any kind of a loan you have, that's really leverage. You're using somebody else's money to get some sort of a benefit for you. In the markets, you can do the same thing. It may not sound like it should be illegal, but it certainly is. And all the brokers will let the public trade the assets that we call leverage assets.
So a couple questions for you then. Does mutual funds have leverage?
No. Typically, mutual funds are it's a basket of stocks, and you are just relying on as many of the stocks within that basket going up to provide a profit for you.
Okay.
What if it goes down? What can you do to protect yourself in a mutual fund if it goes down? Because
Nothing.
A lot of you listening are in mutual funds. The answer is nothing. You can't have what we call a stop loss on a mutual fund. So in other words, you can't say, okay, if my mutual fund is worth $100 right now, that's the net asset value. I can't put like say a sell order at 95, which would give me a $5 loss at the most. You can't do that with a mutual fund. There is another asset that our students use. It's the options in the options market. There is an option position that will act as an insurance policy. You can't do that with a mutual fund.
Okay, so there's a lot of limitations with mutual funds, and I'm bringing this up because our listeners probably know that they know of mutual funds. So that's one question I have for you. The second question is, typically, do institutions, banks, are they investing in mutual funds or do they sell them?
No, they're selling mutual funds. They understand where they can make the most money. Which is in mutual funds. And even brokers, brokers...
Selling mutual funds, not investing in them.
No, correct. But brokers get paid based on commissions that they get, and the products that they sell or provide have different commission structures. And one of the highest are mutual funds and annuities. That's why those are so heavily pushed by the brokerage industry.
Okay, so I guess I got a third question here for you. Typically, where do banks and institutions make the majority of their money? Which assets?
Well, number one, a big portion of their money comes from fees that they charge the public just to put their money into something. But most of their assets come from trading. I think Goldman Sachs, I saw a figure a while ago that said that about 57% of their profits comes from trading.
And I think they call it fixed income assets, which are leveraged assets, futures, Forex, options, stuff like that, right?
All of the big firms, every professional trader out there is going to use one or more of those leveraged assets. So, for a number of reasons. Number one, you can invest a smaller amount of money to control something much larger, which gives you the opportunity to be spread out. So let's just say that you are investing, if you buy shares of NVIDIA, trading around $900 a share. If you want to put a 100-share position together, it's $90,000 in one position. Well, you could invest in NVIDIA using an asset like options for maybe under $1,000 to control that 100 shares, or maybe $500 to control the 100 shares. It allows you then to maybe take some of that additional money you have and maybe invest in Apple or Google or Tesla or whatever. That you can be spread out, you can be diversified.
So a couple more quick questions in about 30 seconds here, Al. Who is almost always consistently profitable?
The Wall Street firms.
Firms, okay. And who typically loses?
The public.
Okay, so if the public typically loses, the firms, the banks, institutions are always making money.
Consistently.
And the public is investing in mutual funds. And the institutions are not. They're selling them to the public. Do you think that might be the disconnect?
Absolutely. That is certainly one of them. There are a number of things that are being used to the detriment of the public, and that's one thing. You're being sold something that is an easy sell, and it's easy because the firms that sell you that, they don't have to manage it. They just turn the money over to somebody else, and then they charge you fees. Not only the people that are managing charge you fees, but the broker charges you fees to hold those assets.
Got it. So if this makes sense to you, we open the whole book on investing and trading and how the markets work in these investing classes. As far as what you can do, what you can't do, what are some of the opportunities that you have that you might want to look at and see if that's an opportunity for you. Simply to come into one of these classes, just text the word investing to the number 210, and that's for 2 seats, one for you and one for a friend, to see what these techniques and concepts are that the institutions are doing, but they're selling you certain things and telling you to do certain things, and that is why the public typically struggles financially. Let's continue that discussion coming up in the next segment. We got a lot more to discuss. This is Josh and Al. Coming up next, we're going to talk about more strategies on how to be efficient with your capital. We will be right back.